Hey guys, so in this video, I'm going over 5 top international stocks that you should consider looking into in 2021. I'll go over the news, stats, and why I think these companies will grow considerably in the long term. Let's get started. The first stock on my list is FIVERR, stock ticker FVRR. This is an Israeli online marketplace for freelance services. I use FIVERR a lot, and if you think the gig economy is going up, then this could be a great stock to look into. Right now, one share of FIVERR is trading at $185.28 with a 52-week low of $129.21 and a 52-week high of $336. If we take a look at the 1-year price chart, we can see that 1 year ago, they were at a pretty low price, shooting past $300 a share back in February 2021. Ever since then, they've been sort of volatile, but I do see signs that it could go up from here. They have a market cap of $6.771 billion. They don't have a PE ratio, and their earnings per share is negative $1.16. Looking at their valuation measures, we can see that they have a price to book ratio of 20.23, which is pretty high. Like I mentioned before, they're still not yet profitable with a profit margin of negative 15.76%, as well as a negative return on equity of negative 12.61%. In the last 12 months, they hit about $250 million of revenue. Their balance sheet shows total cash of $441.84 million, and they have a very good and strong current ratio of 3.29. It's always interesting to see what analysts have to say, so on a scale of 1 to 5, 1 being a strong buy and 5 being a sell, analysts are rating FIVERR as a 1.9, meaning it is a buy. And the average analyst price target is $215.78, which is about 20% higher than the current price of $185.28. So FIVERR is an Israeli online marketplace for freelance services where people can sell and buy services from writing novels to going over resumes to private tutoring. FIVERR is one of the largest companies in the gig economy, and its financial numbers really reflect its success. In the company's most recent earnings report, FIVERR reported a 60% growth year over year, with an increase of 43% in active buyers year over year from 2.8 million to 4 million active buyers. Now, one way FIVERR is growing its business is by extending its reach into the online education marketplace. The company recently announced its acquisition of Creative Live, which is an online learning company where users can log in to attend courses dealing with all sorts of useful, valuable skills. FIVERR discussed that this acquisition was the company's foray into the online education industry and how it's ready to commit more resources and efforts into growing its influence in that sector. This isn't the only instance where FIVERR has proven that it cares about investing its resources to help other businesses succeed. The company recently announced its Future Collective for Black-owned businesses, FIVERR's very own grant program where the company selects 5 Black-owned businesses to which it donates thousands of dollars as well as resources to ensure the success of those businesses. And beyond these projects, FIVERR continues to be one of the top performers in the gig economy. And yeah, if you guys haven't seen, tons of people are leaving their jobs fueled by a desire to work from home as well as to work on their own projects. In my opinion, FIVERR is the first place people should check out if they are thinking about selling services online. They'll report their Q3 2021 earnings on November 10th, 2021, which offers a few weeks of momentum and hype for which the stock might experience some exciting growth. So yeah, be sure to mark that date on your calendars. I think that FIVERR, with the incredible growth it's seen in the past few years, is a stock that deserves to, at minimum, be on your watch list. All right, the second stock we're talking about is NIO, stock ticker NIO. NIO is a Chinese car manufacturer that's most well known for its manufacturing and distribution of electric vehicles. Right now, one share of NIO is trading at $39.97 with a 52-week low of $25.46 and a 52-week high of $66.99. Their 1-year price chart shows that 1 year ago, they were at under $30 a share. They quickly shot up to just about $55, $60 a share back at the end of last year, as well as the start of this year. And since then, it's been quite volatile, hitting another high of about $50 and then dropping back to where it is today. NIO's market cap is $65.908 billion. They're not yet profitable, and they have an earnings per share of negative 89 cents. Now, looking at their valuation measures, we see a price to book ratio of 15.1, a negative profit margin of negative 29.76%, as well as a negative return on equity of negative 53.78%. Right now, they're sitting on total cash of about $46.91 billion, and they have a great current ratio of 2.48. Right now, analysts are rating NIO as a 1.8 $57.28, meaning it is a buy, and the average analyst price target is $57.75, which is about 50% higher than the current price of $39.97. So NIO as a company has already been selling solid numbers of vehicles in China and is already beginning the global expansion of its business. More specifically, NIO has already opened up its first operations headquarters in Norway in late September. This should definitely help with providing investors a very bullish outlook on the company's future success. The fact that NIO is slowly but comfortably growing its business to a new European market is a positive sign for the strength of the company, considering the fact that there is increasing competition in the global EV market. And the company's numbers reflect this strength. Recently, NIO reported delivery numbers for September 2021 and Q3 2021, with over 10,000 delivered vehicles in September alone and nearly 25,000 delivered vehicles in the fiscal quarter. And in its most recent earnings call for Q2 2021, NIO reported a 111.9% year-over-year increase in deliveries, as well as a 127% year-over-year increase in vehicle sales and a gross profit of $243.8 million, a 400% year-over-year increase. And speaking of expanding its business and influence worldwide, NIO recently announced an at-the-market offering of American depository shares, meaning that it has permission as a foreign company to sell company shares directly through brokers such as Credit Suisse and Morgan Stanley. This update is obviously very important for the success of NIO's overseas businesses, and the fact that the company has scored a win in the US market is a very optimistic sign. Now, with the rapid growth of the EV market this last decade, NIO is definitely a company to keep an eye on for the foreseeable future. Yeah, especially if you believe in EVs, this is another solid company to look at besides Tesla. That's why I'll be adding more NIO to my portfolio on this current dip. Stock picks are great and all, but you know what's even better? Getting a ton of free stock with Moomoo. Moomoo is a stock trading platform that I personally use consistently, and right now you'll get free stocks worth up to $400 when you open up an account and make a deposit. Also, the first 100 people who make a deposit of $100 or more will receive one guaranteed share of NIO. This is one of the best promos of any brokerage right now, and I highly encourage you to use the link below to get some free money. Now, as a trading platform, Moomoo offers lots of advanced tools such as advanced charting, free level 2 data, AI tools, and more. It's all stuff that helps you make the most informed decisions before buying and selling, therefore maximizing your profit. I like that they're a zero commission platform that makes no money from payment for order flow, meaning that you're always getting the best buy and sell prices available compared to many other brokerages. I've done my due diligence about their platform, and I'm very confident in recommending it to my audience. Yes, they are a newer platform, but that just means that they need to offer more free tools and more incentives. So yes, more free stocks for people to sign up. Also, to celebrate the 9th anniversary of Moomoo's parent company Futu, they're doing a separate $200,000 stock giveaway as part of the celebration. You guys can use my link below to sign up, and like I said before, you'll get free stocks worth up to $400 in total when you deposit $100 or more, with guaranteed shares of NIO for the first 100 people. I highly recommend checking them out and joining their amazing community of investors. And now back to the video. Alright, so the third stock we're talking about today is ASTRAZENECA, stock ticker AZN. This is a British-Swedish pharma and biotech company that has a large portfolio of drugs and treatments for a wide array of diseases. But really, they're best known for being involved in the development of the Oxford ASTRAZENECA COVID-19 vaccine. Right now, one share of AZN is trading at $61.22 with a 52-week low of $46.48 and a 52-week high of $61.34. Their one-year price chart shows a big jump in prices at the end of last year, followed by a pretty big dip, and now it has recovered significantly. Their current market cap is $189.676 billion. They have a P/E ratio of 42.65, earnings per share of $1.44, and they pay a mild dividend of 2.33%. Looking at their valuation measures, we see a 5-year PEG ratio of 0.99, as well as a price-to-book ratio of 11.89. The current profit margin is sitting at 12.77% with a very good return equity of 25.67%. They're currently sitting on about $15.63 billion of cash, and they have a solid current ratio of 1.23. Analysts do love this company, and they are rating it as a 1.7, meaning it is a buy, and the average analyst price target is $69.28, which is about 15% higher than the current price of $61.22. So while the company is not a major player in the COVID vaccine vaccine market, with the likes of Pfizer and Moderna dominating that sector. The company did develop a COVID antibody therapy drug a few months ago, which is called its COVID prophylaxis drug. And very recently, the company requested emergency use authorization in the US for this particular drug. This is very exciting news for investors because it does demonstrate the company's confidence in this treatment, as well as the possibility that ASTRAZENECA may be a major player in the COVID drug and treatment market for products other than a vaccine. Now, in regards to the company's financials, ASTRAZENECA announced at the end of July for its first half of 2021 that the company experienced strong revenue growth of 23%. And if we're excluding the COVID vaccine, the company's revenue still managed to grow by 14%. And also, if we take a step away from the work ASTRAZENECA has been putting into the COVID vaccine and treatment market, the company has other interesting and exciting opportunities to consider. For one, the company does have a cancer drug called Imfinzi, and it was recently announced that this drug, when combined properly with another medication, substantially increased survival of liver cancer patients when compared to an older liver cancer drug. The same drug was also found to be relatively successful in another drug trial against non-small cell lung cancer. It's apparent that when it comes to oncology and the treatment against cancer, ASTRAZENECA has many interesting and potential groundbreaking projects on the horizon. Also, the company is expected to announce earnings on November 12th, 2021. Yeah, overall, I do think that this stock offers a lot of promising opportunities, and I definitely think that it's a stock that you guys should put on your watch list for the future. Okay, so the fourth stock we are talking about today is Alibaba, stock ticker BABA. This is a Chinese tech company specializing in e-commerce, retail, internet, and technology. So right now, one share of Alibaba is trading at $177.42 with a 52-week low of $138.43 and a 52-week high of $319.32. The last year has not been that great for Alibaba. We've seen that their price has really decreased overall. But if you look at their numbers, it doesn't make any sense, and I think it's extremely undervalued. They have a current market cap of $491 billion, a P/E ratio of 21.24, and earnings per share of $8.35. They have a 5-year expected PEG ratio of 1.75, and they have a price to book ratio of 3.01. Their profit margin currently stands at 19.25%, and they have a return on equity of 13.75%. We can also see that they have total cash of $483.35 billion and a current ratio of 1.76. Analysts do really love Alibaba, and they're rating it as a 1.8, meaning it is a buy, and the average analyst price target is $243.57, which is about 60% higher than the current price of $177.42. So Alibaba is a Chinese tech company that is most notably known for its e-commerce platform. However, the company has a highly diverse portfolio of businesses and functions offering cloud computing, electronic payments, and other services. Alibaba recently announced it would invest $15.5 billion to promote common prosperity in China. Now, what exactly does that entail? Basically, they've set up a committee that will actually use these funds to promote 10 initiatives that will help improve China as a country. While some are highly skeptical of the strategy, I do think that it might be a pretty invaluable business decision, as Alibaba's proof of service to the betterment of China really helps its relationship with the Chinese government. As a result, I think that the Chinese government might work to protect the company from foreign competition. In the company's most recent earnings report, Alibaba reported $31.865 million in revenue, a 34% year-over-year growth. This announcement should leave investors a little bit confused though, because Alibaba's stock, as you guys saw, has declined drastically in price over the last year. In actuality, the problem doesn't really have anything to do with the business itself, as you have seen that the company reports strong numbers and is one of the largest corporations in China. Alibaba's bear run has more to do with China's cracking down on China's biggest companies with a focus on redistributing wealth and resources to the Chinese population. So in other words, I think that Alibaba is a fundamentally strong company that's selling for a lot lower than it should be. I'm sure we all love buying things at a discount, and I think that Alibaba stock right now might be at a huge discount. That's why I'll be adding more of it to my portfolio. All right, number 5 on our list is the Vanguard Total International Stock ETF, stock ticker VXUS. This is an ETF that's managed by Vanguard that monitors many stocks outside the US. You can see that this fund is looking to provide broad exposure across developed and emerging non-US equity markets. So yeah, right now we can see that one share of this ETF is trading at $65.69. Now, in terms of the risk potential, Vanguard does rate this this one as a 5, meaning that it is more risk and more reward. If we look at the performance of this ETF, we can see that it has performed quite well, especially in the last 1 year. In the last year, this ETF is up 24.44%. It's up 8.36% in the last 3 years, 9.05% in the last 5, and 7.91% in the last 10 years. Overall, international stocks do tend to perform not as well as US companies, but still, a 10-year growth of 7.91% is actually very, very impressive. If we look at the portfolio allocation, we can see that 25.3% is in emerging markets, 39.7% is in Europe, 27.7% is in the Pacific, 0.4% in the Middle East, 6.8% in North America, and then 0.1% in other regions. The fund total net assets is sitting at $404.3 billion. The fund carries 7,765 different stocks. And yeah, if we look at some of the companies that are most represented in this fund, we can see that they have Taiwan Semiconductor Manufacturing Co., Tencent, Nestle, Samsung, as well as Alibaba and ASTRAZENECA, which we talked about in this video. So overall, I think that VXUS is a great option for more careful investors who want broad exposures for their investments. And as we've already talked about, some of the holdings in this ETF have exciting things going for them. So yeah, being a holder of this ETF will expose investors to any growth in these companies. Not to mention with the likes of massive, established, and popular companies like Tencent, Nestle, and Samsung in this ETF's portfolio, I do think that this ETF seems like a pretty safe bet for your money. I always recommend to investors, don't put all your eggs in one basket. And yeah, it seems like a lot of people are putting a lot of money into the US stock market, but sometimes it does help to sort of diversify and put your money into some international companies. And as we've seen, this ETF has done quite well over the last decade, and it's just a very great way to sort of invest in multiple international companies with just one ETF. I also love that they have a very low expense ratio of 0.08%. And yeah, like I mentioned, I'm just a big true believer in ETFs and index funds. So yeah, if you guys are looking to put some money into international companies, this is one great way to do that. Anyways, those are 5 top international stocks that you guys should be checking out in 2021. Now, like I say in all my videos, make sure to do your own due diligence. I'm not a financial advisor, and this should not be taken as financial advice. Rather, just look at this as an analysis of 5 international stocks that I personally like. If any of these stocks catches your eye, I recommend doing at least 1 hour research before you put your money into it. And yeah, just as a reminder, if you guys want to get your free NEO stock, you guys can use the link below to sign up for Moomoo, and you will get that free share in your account. Anyways, thank you guys so much for watching. If you enjoyed the video, make sure to hit that like button and also subscribe to my channel for more videos just like this. I make a ton of content about personal finance, investing, and entrepreneurship. Thank you for your time, and I'll see you in the next video. Peace.